there's a huge run, on these banks. So they're all going to fail.
I believe that Jay Powell's going to resign sometime between now and the end of next year.
We have a very special panel with two popular guests, Peter Schiff, Chief Market Strategist of the Euro-Pacific Asset Management Fund, and David Hay, who is his co-CIO of Evergreen Gavical, and we'll be discussing their outlooks on the economy, markets, and risks to investors. Welcome both, Peter and David. Pleasure to host you both.
Thanks, David, for hosting us.
Absolutely. Thank you, David. Great to be back with you. Congratulations on the growth of your show. It's amazing.
Thank you. Pleasure to host you both. Peter, I'd like to start with you. We spoke a couple months ago, and you were talking to us about the risk to the economy. Since then, the equity markets have continued to rally despite what many economists see as warning signs of a coming downturn in economic growth. What could be the catalyst for a downturn in the stock markets?
Well, I think the main reason the stock market is rallying, other than just all the hype around AI, some of which is probably not hype, but a lot of it is being excessively priced into the market. But I think it's all the weak economic data that continues to come out, particularly out of the manufacturing side. But I think investors are looking at all this data and concluding that the Fed is done hiking. And even if it's not done, there aren't many hikes left, and the data is so weak that the markets are starting to price in cuts. And it's the expectation of rate cuts that I think is responsible for the market. And I also think investors are concluding that even if the Fed's rate hikes are not enough to reduce inflation, that a recession will do the Fed's job for it. That if we finally get a big downturn in the economy, particularly in the labor markets, that's going to bring the inflation rate down to 2% or lower. And so the markets are, excited about that and starting to price that in. But I think they're completely wrong. I think they're correct in that the economy is weak, but it's not going to reduce inflation. I think if anything, the next recession is a catalyst for a leg higher in inflation, as much larger budget deficits result in even more money printing and a real return in earnest to quantitative easing. In fact, I think that just the widening budget deficits and the explosion in the net interest cost to the government is going to cause the Fed to step up the money printing. So I think it's going to be stagflation. It's going to be a weaker economy, but much stronger inflation. And that is not a positive environment for the markets, particularly a lot of the growth-oriented type tech names, the types of stocks that investors should be buying that are really inflation sensitive are the ones that they're still ignoring.
David, how would you respond? Do you share his views on the stock markets at least?
Pretty much. I mean, obviously the stock market has had extremely bad breath, market halitosis in the first half of the year. It has broadened out a little bit lately with the average stock perking up, but the median stock in the S&P is only up about 5.5%, so it's still way, way behind the S&P. We know it's the Magnificent Seven that's been leading the way. But I think what Peter was saying there toward the end of his comments was really critical and something I totally agree with, and I think the markets are greatly missing, and that is what's going to happen when we do have a recession. And I think where I would disagree a little bit, just because I listen to the mainstream media on a regular basis, at least if CNBC qualifies, which I think it does, their attitude is, actually making fun of people who've been saying the economy is going to have a recession. And, what are these people talking about? They keep saying all this bad stuff's happening, and yet the economy is just fine. Thank you. I don't think it's just fine. I agree with what Peter was saying, but I think that's one of the disagreements I have with consensus right now, because if you look at, I think Peter touched on this. We got an industrial recession. We've got actually falling GDI, gross domestic income, which is arguably more accurate. And if you put GDP along with GDI, you get the GDP plus, and that's clearly flashing recession. You've got a yield curve that is deeply inverted, that's had a flawless track record when it's been this inverted. You've got the leading economic indicators falling for 14 straight months, and they're called LEIs for a reason. They do lead. Yet the market's really blowing that off. And, you could kind of look at even the transportation average, which is up 16% this year. And that's pretty remarkable if we really are on the cusp of recession. You say, well, that's airlines, trucking's bad. cardboard recession underway. I mean, there's lots of cross currents, I think, to be fair. So I think if a person wants to take an economically optimistic outlook, they could. But I think it's looking at generally lagging or at best coincident. If you look at the leading stuff, it's flashing orange, if not red. So I think that's what the market's missing right now.
Peter, I'm going to come back to you and your economic outlook. Last time we spoke a couple of months ago, you had called what's coming up what could be, in your words, a Great Depression worse than the 1930s. This certainly contrasts with the Fed's view, which is that, well, their own staff projections show that we might get a mild recession. Jerome Powell thinks we'll get no recession at all. Where is the discrepancy between your view and perhaps the Fed's view?
Well, first of all, the Fed is not honest. Even if the Fed thought a severe recession was coming, it wouldn't admit that. It would try to put a smiley face on it and hope that positive talk would mitigate the severity of the downturn. But we're going to have a major economic contraction because we have to work off really 20 years of excesses that were the consequence of artificially low interest rates. I mean, the excessive debt and consumption and speculation has come at the expense of serious damage to the underlying structure of the economy. And all this has to be worked out one way or the other. And so it's going to be a very painful process that is going to be elongated by government's efforts to mitigate it and get in the way, because the recession is the market's method of repairing the damage that was done as a result of all the malinvestments and misallocations that were a consequence of the Fed's manipulation of interest rates. But when the government tries to push back against that correction, it just elongates the process and makes it more painful, which is, what we've been doing. Every time we start to see a problem, we slash rates and print money. We just saw several large banks fail, and a lot more would have already failed had the Fed not stepped up and backstopped everything. But that doesn't mean we're out of the woods. I mean, all of the problems that resulted in Silicon Valley Bank or Signature Bank or whatever going under, those problems are there throughout the entire banking industry. All you have to do is think about all of the mortgage refinancings that occurred over the last 5 or 6 years, where you've got all these 30-year mortgages in the threes. That's great for the borrowers, but what about the banks that are holding all that paper? They're underwater. They're losing a ton of money on these mortgages. Think about all the commercial mortgages that were extended, where the collateral has collapsed, where commercial real estate values have been halved or down even more than that. So you have all this negative equity in all these loans that the banks are holding on to. Plus, the banks also have large portfolios of government, treasuries, where they own 10 to 30-year maturities, again, where they're collecting 1% and 2% interest in a 5% environment. So they're losing a lot of money on these loans. Meanwhile, everybody is loaded up with debt. Student loans now are getting close to $2 trillion just there. Credit card debt, record territory. Everybody has debt. Corporations, just went on a debt binge during the era of cheap money. And their balance sheets are at risk dramatically as all this low-yielding debt matures into a higher rate environment. And look at the federal government. I think interest on the national debt right now is $600 to $700 billion a year. That's double where it was about a year ago. By the end of this year, it'll be about $1 trillion. By the end of next year, the U.S. government will be paying $2 trillion a year in interest on the national debt, which will be about $35 trillion by the end of next year, headed for $40 trillion, probably in another year or two from there. And that's if interest rates don't even go up. What if rates keep rising? What if they go to 7% or 8%? So this is a huge debt bomb that's going to explode.
David, let's respond to Peter's comments. How do Peter's comments fit into your thesis of bubble 3.0?
Well, he was talking about the malinvestments that occurred because of interest rates being artificially suppressed. And as Stan Druckenmiller said recently, that when you have money too cheap, people do stupid things. And when you have money too cheap for 13 years, people do really stupid things. And we've seen a ton of that. I do think bubble 3.0 was the biggest of them all. The first being the tech bubble of the late 90s, then the housing bubble of the 2005 to 2007 period, which almost brought down the global financial system. And that's really one of the points of my book, which when I wrote it had not morphed into a banking crisis this time, as opposed to the bubble 2.0, which involved mortgages. But what Peter's saying is I absolutely agree with. And again, I think the consensus is missing this. I think the majority view right now is the banking crisis is over. And I don't think it is. In fact, S&P has said 576 banks are dangerously exposed to commercial real estate. And as Peter already touched on, commercial real estate is a disaster, at least in certain parts of it. Clearly office buildings, where you're seeing the commercial equivalent of jingle mail, where these guys are basically just turning their buildings back to the lenders. Chris Whalen, who was way ahead of this, a lot of people believe, I think the consensus viewpoint again was early in the year, late last year, that higher interest rates were good for the banking system. And he was saying, whoa, up to a point, but it's gone way too far. This is going to become a systemic problem. He was right. He thinks that all banks are suspect. And I think what Peter was saying is true, that the first part of the crisis, banking crisis, was because of their safest securities. What I believe, once again, the market's missing is the second part of the crisis is going to be the hits on their loan book. So I think that's a major problem. And I think it ties in with corporations and the high levels of debt that they have. Not only are the levels high, but a lot of it's floating rate debt. So you're getting an immediate impact on companies' cash flow. So that's a big issue. Something like $3 trillion in floating.
The banks are losing their deposits because
absolutely
they can't pay interest. And so people are yanking the money out of banks and buying money markets. So they're lending their money to the US government at 5%. And so the banks are losing all their capital in addition to the value of their loans going down. The whole banking sector is completely insolvent, thanks to what we've done over the last decade or so by loading up these banks with all this long-term, low-yielding debt, we had all these deposit insurance, so nobody really cared about what the banks were doing with their money because it was all insured by the government. But now, though, that people have seen these large banks fail, and the government has said, look, we're not necessarily going to cover your bank if you have more than the FDIC amount. It's a case-by-case situation. We're going to have to evaluate the systemic impact. The message that sends is if you're a customer of a small bank, a regional bank, a community bank, and you've got a large account, you just better get your money out. There's no reason to leave it there. They can't pay you enough interest to compete with a money market. And what if the bank fails? You may be, SOL. And so there's a huge run, on these banks. So they're all going to fail. And the government, obviously, if it wants to bail out every one of these banks, the only way it can do it is by destroying the value of the deposits because of massive inflation. Because the money to bail out the banks has to be created by the Fed. It's the only way they're going to get it. The FDIC doesn't have any money compared to the trillions of deposits. And so it doesn't even matter if your bank fails. You're going to lose money if you have a bank account, because either the bank's going to fail because the government doesn't bail it out and you're going to lose your deposits, or the government bails out your bank and your deposits lose their value because inflation destroys the purchasing power. So no matter what happens, people are going to lose a tremendous amount as this banking crisis unfolds.
David, which of these assets that you referred to in your book are most likely in or most severely in a bubble territory right now?
Well, first of all, there's been a lot of deflation that's occurred since I wrote that book. That we published it in early 2022 when it was still, almost at its maximum size. But, even with this, what I'd call the echo bubble that we're getting right now, there's still been a tremendous amount of damage done. But I think that, what you've seen with the NASDAQ 100, which is just like the overall market, incredibly concentrated rally in a few names, that's probably a pretty good hedge for people that are looking to protect from the next down leg. I would say, puts on the NASDAQ 100 wouldn't be a bad call. And I think Apple's a great company, but it's 30 times earnings. Revenues have actually been negative, and yet it's trading at a $3 trillion market capitalization. Hard to make money on those kinds of stock, I think, over the next 10 years. I think where you're really going to make good money is in some of the bombed out commodity areas, which has, of course, been helping the Fed in its battle with inflation. We've seen a big drop in things like lumber and, of course, even oil. But I think that's what is going to be the big shock in the second half, is I think you get another spike coming in oil prices. We've talked about this before. I think oil inventories are just dangerously low. That's been another government intervention with all these SPR, strategic petroleum releases, which have made it look like inventories are fine, but they're not fine. And that's going to hit the fan here, I think, very soon. And that could be the next problem that the Fed is facing, is more energy inflation. I would agree with Peter that the Fed has just created an untenable situation. I actually, to go out on a limb, I believe that Jay Powell's going to resign sometime between now and the end of next year, because I don't think he wants to be around when the Fed has to do what Peter was talking about earlier, which is get back into debt monetization mode. I think one of the words we're going to hear more and more as time goes by is fiscal dominance, which is basically the idea that the Fed has to finance the government because nobody else will. And as you know, one of my big fears for the second half of this year is what I call the 4F scenario, the federal fiscal funding fiasco. I just don't see where the trillions of dollars are going to come from to finance the government at these kinds of interest rates. I think ultimately it's going to have to be the Fed that does it with their magical money machine. And that will be not great for the stock market, but it could be great for commodities.
Peter, can you respond to that? Will Jay Powell be in a position where he has to resign?
Well, I don't know. I mean, if he's going to resign or not, I mean, and who they're going to replace him with. But, the thing Jay Powell is that, he refuses to criticize the government for the deficit spending, which is absolutely his job. That's exactly what he's supposed to do. He claims that, well, we're independent. It's the government that's supposed to stay out of the Fed, not the other way around. If the Fed is independent specifically so it can criticize the government when it does something wrong, when the government is pursuing excessive fiscal policy, it's up to the Fed chairman to call him out on it. That's exactly what Paul Volcker did. I mean, Powell likes to talk about Volcker. Volcker was a staunch critic of the deficit spending during the 1970s, and he called on Congress to not only just cut spending, but he specifically said, you got to cut defense spending, you got to cut Social Security, you got to cut Medicare, you got to reduce these deficits because they're creating inflation, they're undermining economic growth. But Powell refuses to criticize any of these deficits and just says that it's none of the Fed's business, and the Fed is just going to take whatever fiscal policy is presented to it. Well, it can't do that. I mean, if it wants to fight inflation, it can't do it unless it's willing to bankrupt the government and just say, okay, well, you're going to run these deficits, we're not going to finance them. But of course, he's not going to do that. He's going to do whatever he has to finance those deficits. He's not going to allow a default. So I don't know if he ultimately has to resign so that he can get out of Dodge. But the markets are just completely oblivious to the reality of what's going to happen. They just think that we could go back to sub 2% inflation. It's impossible. The only reason that we had it for as long as we did had to do with all the lags. But we created all this inflation, and now the chickens are coming home to roost, and they're just getting started. And as we have to ramp up the printing presses again, all they're doing is throwing gasoline on the fire. But the fire hasn't gone out. It's still burning.
Yeah, Peter, just to follow up on that, why do you think the markets are expecting lower inflation? I'm looking at the 2-year expected inflation rate, for example. That's a 1.5%. The market's actually expecting in 2 years' time inflation to be sub 2%, not even at 2%. This is headline CPI. What assumptions do you think the markets are making right now?
They're just looking at the time period prior to COVID, and particularly from the 2008 financial crisis through COVID. And they're just assuming that that's normal and we're just going to go back to that. And they're wrong. I mean, that wasn't normal at all. That was an aberration. And a lot of it was driven by foreign central bank buying of dollars, particularly early on, 2011, 2012. You had the currency war. You had all kinds of emerging market banks that were buying up treasuries and U.S. dollars. The opposite is happening now. There's a move to de-dollarize. A lot of the biggest buyers of dollars are sellers. They don't want U.S. Treasuries anymore. They don't want our mortgage-backed securities. So we don't have the ability to keep exporting our inflation the way we did it back at that time period. Plus, we're just catching up to all that inflation, because initially a lot of the inflation, as it worked its way into the real economy, went through financial assets. It went into the stock market, into the bond market. And now that inflation is already migrated into the real economy. It's in consumer goods, it's in services, and it's there to stay. It's just taking hold, and it's going to build on this momentum. So we're going to have very, very high inflation for many, many years. And the government can lie about it and try to hide it beneath these rigged CPI numbers, but it's now so bad. It's just that the markets haven't come to terms with that yet. Just like they initially thought inflation was transitory, then they thought, okay, it's not transitory, but the Fed can easily put this genie back in the bottle. They're going to find out that that expression is here for a reason. They said, don't let the inflation genie out of the bottle. Why? Because it's very hard to put it back in. And the Fed made the mistake of letting it out of the bottle because they were too afraid of what might happen to the economy if they tried to keep it contained in the bottle. But now that it's on the loose, there's no way. And in fact, even Powell just last week in his speech acknowledged that inflation is probably not going to go back to 2% until sometime in 2025. But of course, he's wrong again. I mean, it's not going to be anywhere near 2% in 2025.
David, let's respond to this. If you take a look at core PCE has been sticky around 4.6 to 4.7% ever since the beginning of the year. It's come down since last year, but it hasn't fallen since February, I would say. The latest reading was 4.6, which is slightly lower than the previous month, but not by much. Why do you think energy and food inflation has been sticky, David?
I think some of the reasons that Peter mentioned. I think that is inflation has been non-transitory for as long as it has. Then you start to get labor militancy, and you're seeing that with the UPS contract right now. So you're getting a wage pressure that you haven't had in many decades, and wages are inherently sticky, right? It's hard to cut people's pay, and the way to deal with that is to do layoffs, and companies are starting to do that, and I think that will continue. And I don't think the jobs market is nearly as robust as the official statistics. A lot of that's due to the birth-death model, which is overstating business formations and understating employees, basically being terminated. So I think it gets back to how confusing the situation is. And I think that's typical at inflection points, which I think we're in the midst of. I think we're in the process of inflecting down. And one thing that I would bring up that kind of touches on what Peter was saying is that where I think Powell is really naive is this belief that inflation is going to get better over the next few years. I think it's going to get worse over the next few years. I think we're going through a period caused largely by falling commodity prices, especially energy, where inflation looks relatively calm right now, again, backing out wages. But a lot of the forward-looking inflation statistics are actually looking relatively encouraging for now. But I think we've got these underlying structural, secular upward forces on inflation, such as reshoring. That's one thing that's happening. If you look at construction activity, like for plants, it's just absolutely going ballistic right now, because we are trying to reindustrialize America. That's got some very positive aspects, but I think it's inherently inflationary. You and I before have talked about what I call the great green energy transition, or greenflation. That's by definition inflationary. We're replacing more efficient sources of energy with less efficient sources of energy. So you've got these kind of underlying upward lifting forces on inflation, but near term, it looks okay. And that happened in the 1970s. If you went back to look
also, we did have a pullback in commodity prices, but what happens if prices are troughing and we're on the verge of another move up in commodity prices?
Exactly. That's what I was saying. I think that's what's going to be the big surprise of the second half. And I think particularly if you get oil in triple digits again, which I think is highly likely, and then the Fed's going to be in a tough spot.
I left Vienna this morning, and in my hotel where all the OPEC ministers are having a meeting today, and their headquarters is like a couple of blocks away, so they all stayed in the same hotel. And I saw all those guys; they seemed like they were serious when they were meeting and getting. They had security guards and police there with them. But yeah, I think that we're going to see a move up in commodities, and especially if we get a leg down in the dollar's been kind of holding steady. But if it breaks, based on all the weak economic data and the anticipation of a softer Fed, and when you mention these job statistics, one of the things about the jobs numbers that nobody seems to really pay attention to is that one of the main reasons that so many jobs have been created over the past year is because so many people who already have jobs need second and third jobs to get by. And so it's inflation that is driving these jobs, but it's not because the labor market is strong. It's because the labor market is weak and somebody can no longer support themselves on one job. And so they need multiple jobs. And if you look at the statistics, we have a record number of people working multiple jobs. Some of them are multiple full-time jobs. But also what I think a lot of people are doing, and it's getting into these numbers, is there are people who are working from home and they're taking 3 or 4 or 5 jobs, and they're not even doing them, but it takes a long time for them to get fired before their employers figure out that they're not working. But there's a lot of these jobs that are being created because of those dynamics. And a lot of the jobs that are being created, these part-time jobs, second and third jobs, they don't pay very much. That's why people need 3 jobs. They lose one good job and they replace it with 3 lousy jobs. That's a win for the statistics because that's 2 more jobs.
What it is, Peter? You know what it is? It's the I blame the mouse shifting software. The software you put in and it makes your mouse move and your employer thinks you're working. That's what that is.
Yes, but these numbers are very deceiving.
Well, speaking of deceiving numbers, so something that I wanted to bring up, and you were talking about the deficit spending, that this used to be talked about. I think Jeff Gundlach brought this up a lot of times in the past, but I haven't heard even him discuss it recently, which is the idea that if you look at the nominal GDP growth, which is about 7%, and if you look at deficit spending, it's about 7 to 8%, right? Aren't we looking at deficits in that area, Peter, for this year? I mean, roughly at $2 trillion, maybe a little under that deficit. So
the deficit is getting closer to $2 trillion, actually, but
yeah. So 7-8% of nominal GDP. So if you back that out, where's the growth? So you would have 0 nominal GDP growth if it wasn't for these massive deficits that we're running at a time when unemployment is sub 4%. That's just unbelievable. I mean, what's going to happen to the deficit when the employment rate goes up by 200 basis points?
Yeah, 2%. Nobody is talking about where the next deficit is going to be, because when we go to a situation where we get 10% unemployment again, and we get a big economic contraction, you're talking about maybe $4 to $5 trillion deficits. I mean, because every cycle, the deficits get bigger and bigger, and the QE required to finance them gets bigger and bigger. And I don't think we can go for another cycle. The numbers are now too big that there's no way we can goose the economy with that much drugs and not overdose at this point. And to start having the deficits grow at that type of rate. And then the markets would have to realize that, wait a minute, the balance sheet is going to grow forever. It's all this talk about reducing the balance sheet and that you're not monetizing the debt and that America isn't a banana republic is just a fantasy, because the deficits or the balance sheet can never be contracted because they can never get far along in the process without another recession kicking in, and now they have to ramp it up, and it has to get much bigger than it was than the prior peak. And so it's just always going up. It can never go down. Eventually the bottom has to drop out of the dollar. And that's when we have a real crisis in the country, because then once the dollar starts to spiral and it pushes up interest rates, long-term interest rates, and now the Fed is forced to print more money to stop rates from rising, then it just accelerates the process of getting rid of the dollar. And then you get into a currency crisis, which is much worse than just a financial crisis.
So what he just described, David, is why I don't think Powell's going to stick around. He's not going to go for that. He's not going to do QE6 or whatever number it is. So that's why I think we're going to have somebody that's more pliant, believe it or not, than he is at the head of the Fed. But I also think it's important for us to think about what should investors do instead of yeah, we obviously both like commodities, and gold is a logical hedge and so forth. And there's people that love crypto for that reason. I think Peter and I are both crypto skeptics. But what I do think makes some sense, because this is the time in a investment cycle where I would normally be extending duration for clients and buying long-term treasuries. I don't want to do that for all the reasons that Peter and I have talked about. But I think people need to be locking in yield at this point in the interest rate cycle. And I think where there's really an opportunity is with emerging market debt. Certainly not all emerging market countries, not Turkey, but you look at countries like Indonesia, even Brazil, where Brazil's got interest rates of 14% with inflation down in the 4 to 5% zone. I mean, that's like Paul Volcker. So what's ironic is that many of these emerging markets have actually been following more responsible fiscal and monetary policies than the West has, and certainly the US. And ironically,
go ahead.
Well, I was just saying there's a number of these closed-end funds that own emerging market debt that are trading at double-digit discounts and double-digit yields. Sorry, what were you?
Yeah, I don't own I don't manage a closed-end fund, but I'll call your attention. Maybe you should take a look at it, but so can some of the viewers here. But so I managed an open-ended mutual fund, the Euro Pacific Bond Fund, and for the reasons that you're stating. And so my bond fund is the number one bond fund in its category this year. I think there's about 200 funds in our category. We're up about maybe 6 or 7% year to date, whereas the category is up 1%. I mean, we're crushing it. And the reason that the fund is doing so well, and we're also a 5 stars now over the last 3 and 5 years. We're not quite number one over 3 and 5 years yet, but I think by the end of this year, we'll be number one going back 5 years. But this year, we're just so far ahead of everybody because of the type of debt that we own, the emerging market currencies and our short durations. But yeah, I mean, if you're going to be in bonds, I mean, the Euro Pacific Bond Fund is the place to be. I mean, we're still pretty small. I mean, we're not on anybody's radar. I'm surprised, because last year my dividend payer fund was the number one fund in its category of 350 funds, just because of our sector allocation and stock picking. But I mean, it didn't, necessarily result in that many flows. I mean, people don't even notice how far we're beating our benchmarks and our categories because they still don't get it. But I think this is just an early indication of what's going to be happening, because I was underperforming for many years until the last few years when I really caught up and then just, took off based on, the forward thinking. We were looking forward to what's happening now years ago when what other people weren't even considering the possibilities. But it's going to get a lot worse, which means I think these funds that I'm managing are going to do a lot better. So you might want to take a look. You can't get a discount because it's an open-ended fund. But that you don't have to worry about it, the discount getting bigger. You can always get out at NAV. So it's a good place to park money if you don't want equity exposure. If you just want to be in cash, but get yield.
Isn't there a U.S. dollar risk associated with EM debt? Can you comment?
Sure. But I would argue it's more reward than risk at this point for all the reasons that Peter and I have been articulating. I mean, these emerging markets have much lower debt levels. Generally, they run trade surpluses. What's lost in the focus on the horrendous U.S. Fiscal deficit is our trade deficit. I mean, that's been running, pretty close to $1 trillion and just year in and year out. And that's one of the biggest problems the U.S. has, is that we are a major debtor country. People will look at Japan and say, I look at the deficits and debt levels that Japan's been able to run up, at least on the government side. That's because they owe it internally. They have typically run major trade surpluses, and they have enormous overseas assets. We're the inverse of that. So I think we're exceptionally vulnerable. And that's why I'd rather have plays against the dollar.
Yeah, we are the world's biggest debtor nation. We're not a creditor nation like Japan. And in fact, we owe more debt than all the other debtor nations of the world combined. And, the last time we had a big inflation problem during the 1970s, and we kind of solved it during the 1980s, we were the world's biggest creditor nation in the 1980s. And we could afford to pay the high interest rates that were required to bring down inflation. But, we have these twin deficits now. No one even talks about it. We were talking about $1 trillion trade deficit and a $2 trillion budget deficit. That's $3 trillion during good times, supposedly. Wait till you see what happens during bad times. And even Donald Trump, who ran, his main campaign platform was bringing down the trade deficits. I mean, one of his themes was that we have to make America great again by reversing these trade deficits, by reindustrializing. Well, when Trump left office, the trade deficits were at new all-time record highs. And then Biden broke that record, and we got even bigger deficits. So those deficits are off the charts. Nobody talks about these twin deficits now. I remember when they were a big problem in the 1980s, people were worried about the trade deficit when it was a fraction of what it is right now. And they were worried about the budget deficits when they were a fraction of what they are right now. Right now, you have maximum complacency because we've gone so long and these deficits have grown so large without any apparent negative consequences. So everybody has been lulled into this false sense of security that because we haven't had a major crisis, that we never will. But just when you least expect it, it's going to hit.
So I want to jump in here, David, because he said a critical word, complacency. And I think that that's really what could be the ultimate bubble right now, is in complacency, because all this stuff that we're talking about, all these statistics that Peter and I are citing aren't made up. I mean, that's just reality. And yet you don't hear that on Bubble Vision on CNBC or among, the market cheerleaders. I mean, you get a few, truth tellers out there like Mike Wilson, who's pointed out that the earnings quality is the worst of 25 years. But for the most part, there's this, especially when the market's going up, it's just amazing. It's kind of like they say in sports that winning is the best deodorant, and a bull market, or at least a big bear market rally, is the best deodorant for the stock market and the economy. But the reality is the underlying situation is extremely alarming.
Well, I have a question for both of you.
You mentioned one thing real quick. You mentioned the leading economic indicators and how bad they've been for the last 13, 14 months. The only positive in the LEI is the stock market. So the stock market keeps going up. And I don't even think that should be a leading indicator anymore. In fact, I think it should be the reverse, because the stock market only goes up when people are negative about the economy. It should be a falling stock market that should be a leading positive indicator. The market is only going up because people look at the other indicators and realize how weak the economy is, and they think that means the Fed is going to come to the rescue.
But the counter argument is, why fight the trend? I mean, the underlying economic forces that you've described are weak, but if the consensus out there, Bubble Vision, whatever you may want to call it, is bullish, why fight that? Why fight the bull?
Well, I mean, you could have said the same thing in 2007. Look at 2007. The market was acting like everything was great. It made a new high in the fall of 2007 as things were falling apart. We're on the precipice of the worst recession since the Great Depression. So the market's not a great forward indicator, frankly. And I think what Peter said is kind of interesting. It's almost a contra indicator.
And I'm not fighting it in that I have a lot of equity exposure. I just have foreign stocks, emerging markets, commodities, energy, in metals. I'm looking for inflation hedges. I'm looking for assets that I can own in an inflationary environment. I'm just not, piling into the S&P or the NASDAQ names that I don't necessarily think are going to be that good a hedge. And especially if we end up with a dollar crisis and a real crisis in the United States, where people are looking to flee U.S. assets, which is where I think this is ultimately headed, then I don't want to be in our markets. I think that there'll be much better real returns to be made abroad. And we're seeing a lot of my stocks that I own in the last week have hit 52-week highs. They're doing well. My gold stocks are the ones that are lagging, and those are the ones that I feel should be doing the best. But they're not, because again, investors still don't understand what's happened and where we're headed.
Hey, David, if you want to have people go with the momentum, how about Japan? Japan's markets have broken out to multi-decade highs. When I look at stocks making multi-year highs, unsurprisingly, it's heavily populated by Japanese stocks. The yen is extremely undervalued on a purchasing power parity basis. And I think that's an interesting play too, is because I believe that the Bank of Japan is going to have to give up on yield curve control here soon, where they keep the interest rates at 0.5% on their 10-year JGBs, their government bonds. I just don't see how that continues. And by the way, that's been another kind of artificial liquidity injection that's been going on that is, I think, also buoyed U.S. assets, is what they're printing a lot of yen to keep those interest rates down. You've also had this ERC, it's employee retention credit, $20 billion a month that's been pumping in to the U.S. economy. That's going to go away. You've had student loan forgiveness. That's going to at least partially go away. There's a number of headwinds that are going to kind of hit all at once that the complacent consensus is missing. But I do think it's important to be bullish. There are places to be bullish.
When the Bank of Japan throws in that towel, and allows yields to rise, that could be a huge problem for the U.S. because that's going to cause the yen to move up quite a bit. It probably will cause a correction. And I own quite a few of these Japanese stocks, and I see them almost every day. Some of these stocks making new highs, and I think there will be a correction in the dollar price of those stocks. I mean, the yen will rise, so from an American perspective, you may not see it as much. And that's going to have to, there's going to have to be some fiscal responsibility in Japan. They're going to have to do something because if the Bank of Japan lets rates go up, they're going to have to start cutting spending. They're going to have to do something to rein in their deficits, and they'll have no choice. But that is going to be a big problem for the U.S. because a lot of that liquidity has been coming from Japan, and when it dries up and the yen starts to rise, that's going to be a major problem for the U.S. and our ability to finance our deficits.
So again, David, I would just say for your viewers, that's a great way to hedge because I do think that's inevitable. And there are a number of ETFs out there that can give you long exposure to the yen, the currency. So especially if you own Japanese stocks, I think what Peter said is true. That would, your dollar price would actually go up in that situation if the yen's rallying. But on the other hand, it's a negative for the fundamentals of the companies because Japan's still a huge export country. So there are definitely, I think the one message I want to convey is that rather than get into a foxhole, I think there's ways for investors to take advantage of these bizarre trends that have been building for years and years and years, and I think are coming to a culmination soon.
Speaking of bizarre trends, I want to end on crypto as a trend. Peter, I think you were recently invited to a crypto conference. What were you doing there?
Well, I was at two. So I went to a blockchain conference in London a few weeks ago. And I just left a few days ago. I was at a blockchain conference in Hamburg. So, yeah, I'm going to these conferences mainly as a counterpoint, to try to represent the other side. The one in Hamburg, though, it was disappointing in that when they first invited me and I agreed to do it, Michael Saylor was going to be there. He was one of the speakers, and they were going to try to arrange a Bitcoin gold debate between me and Saylor. And I've been trying to get that debate. He's been ducking me for years. People keep trying to arrange it. Go ahead, David, contact him. He turns down every offer. But once he found out I was going to be there, not only did he refuse to debate me, he just decided not even to go to the conference. He just backed out of the entire event. So I had to do a Bitcoin gold debate with some lady I didn't know. She wasn't nearly as big a name as Saylor. But it's too bad that he refuses to debate me in public about Bitcoin, because he says a lot of really crazy things about it, and nobody really wants to call him out on it. So that's what I want to do, but I like to do it face to face. He likes to criticize me when I'm not around to fight back.
Well, I mean, I don't know what happened, but maybe he had other plans. But let's assume you're right. And
but he claims he was tired of flying. Because he went to Prague like the month before for a conference. So
what's something he said? Let's suppose he were here. Let's suppose he were here today. What's one of his core theses that you would disagree with?
Well, his main thing is that Bitcoin is like the greatest property ever invented. I'm like, well, how is it a great property when there's absolutely nothing that you could do with it? I mean, he likes the fact that it's easy to transport it. Sure, it's easy to transport nothing. What's the big deal? If you got nothing, it's you can easily, send it around. But he talks about Bitcoin and he says it's energy. Like it's energy. Bitcoin is like energy. And I would just like to ask him, how is it like energy? You need a lot of energy to make it, but once you've made it, you've lost that energy. It's not like it's a battery that stores the energy. It's whatever energy has been used to create a Bitcoin is wasted. It's gone. Once you have the Bitcoin, you don't have anything except the bill for the energy that you use to create nothing. But he just, thinks that no other property has value. He hates real estate. He hates stock. He hates gold. He says that the greatest asset ever invented is Bitcoin. which you can do absolutely nothing with. So somehow this has all this value, but real property, actual businesses, a real commodity, these things have very little value, but this digital string of numbers somehow has all this value. It's just, it's preposterous. And why is Bitcoin better than the other 20,000 some odd tokens that exist, or that could be created that don't yet exist? It's just, the arguments are asinine.
I do want to get David to respond, but Peter, just one more follow-up. The problems with our economy, in particular money printing, inflation, which in your definition is the Austrian definition is the increase in the money supply. Wouldn't those problems, some of those problems at least, be fixed by anchoring our monetary system to a form of money or an asset that has a fixed supply like Bitcoin? That's one argument for Bitcoin.
Yeah, except but Bitcoin doesn't have any underlying value. So trying to anchor a monetary system to something that's worthless doesn't make any sense. Gold is money. I mean, what we need is to go back to a monetary system that actually is built on money. When we had paper, the paper currency derived its value from the money that backed it up. That's what gave the original, paper money, dollars, Federal Reserve notes, had value because they represented ownership of gold, and they could circulate as a more convenient way of transacting in gold, because you would transact in the bills rather than the bullion itself, but the bills derive their value from the bullion. So we have to go back to a real monetary system. I think with today's technology, with the internet, whether we use blockchain or something else, it's very easy to digitally represent gold so that we don't need paper. We don't have to be constrained by a physical bill. You can digitally replicate gold, and you can transact in digital gold that derives its value from the actual gold. And it doesn't have to be a fixed supply. It's okay if the supply of gold grows by 1% a year or so, which is the historic average. That kind of inflation is fine. The population grows by more than that. And so that works. I mean, gold has worked as money for thousands of years. We don't have to reinvent the wheel. We could just find ways of making the wheel more efficient with the technology that we have. And eventually that's where we're headed. I mean, there's no way the current monetary system will survive. It is impossible because the governments will abuse it through inflation. I mean, inflation is just another form of taxation. And it's an easy way to extract taxes from the public because the public doesn't know they're being taxed. The public thinks they're getting something for nothing when the government spends money without collecting taxes. But it pays for it by printing money, and it destroys the value of everybody's savings and everybody's wages. And then prices go up. That increase in price is a tax. But the public doesn't connect the taxation to government because everybody blames rising prices on greedy corporations, on Putin, on OPEC, on everything but the government. And so the government likes that because it doesn't have to accept responsibility for the taxes that it lays on the public.
David, I'll move on to you, and I'll give you the last one on Bitcoin. I don't think you and I have spoken about Bitcoin before. So let me throw this question out at you. Just given Bitcoin's price history, some would argue that it is the ultimate store of value. Just by looking at its price history, it's outperformed everything in the last 13 years. What's your response?
Well, that's because it started at a low point with very low exposure and ownership. But the problem with it, like all highly volatile assets, is when do most people put in most money? They do it at high points when it's really running. And we see that even with our clients, which tend to be, fairly well-disciplined, sober people. But they, when Bitcoin gets going and the press is, giving it the, big highlight, they just, they can't resist. And I know they've done some speculating it outside of us. It's just one of the facts of life in the investment business is a highly volatile asset tends to destroy wealth because people buy it and sell it at the wrong time. And I don't think there's been anything more prone to that than Bitcoin. But the other thing I would say that's just simple, and Peter was kind of touching on this, is that try to run the world without energy, without oil and gas or uranium, or without food commodities like wheat. You can't run the world without those things. You can run the world just fine with Bitcoin, without Bitcoin, I should say. Bitcoin wasn't around and the world was doing fine. In fact, I'd say that probably over the period of time Bitcoin's done the best has been when the world economy's been performing the worst. And, it's the best of a bad bunch in my view. I do like, the scarcity part of it versus something like Dogecoin, which has absolutely no brakes on it. But, really to Peter's point, I do think that we are going to have to replace the dollar with something else. I think Americans would be well to study the history of Weimar Germany in the early 20s and how they got into the disaster that they did. And I know they had reparations that they couldn't pay, but we've got entitlements that we can't pay. I mean, Druckenmiller saying that the present value of the entitlements is 200 trillion. And that's on top of the 32 or 33 trillion on budget debt. We can't pay that, much less, those entitlements. So in a way, it's kind of like the reparations for Weimar Germany. And yet
we're actually more heavily indebted than the Germans were. We borrowed a lot more money than what they borrowed to pay that war, and we can't pay it either. I mean, so yeah, I mean, but the point of you're making about Bitcoin, because all these guys always try to tell me it's the greatest store of value because it's gone up so much. But well, that's not a store of value. I mean, the fact that it went up so much, it's a speculative asset. But the price got to almost 70,000. Now it's 30,000. The majority of the people who own Bitcoin are losing money in it. They're not making money. But if you just want to go back and say it's the best performing asset over the last 10 years, if Bitcoin were to fall from 30,000 to 1,000 over the next year, you could still make the argument that it's the best performing asset because it went from pennies to 1,000, right? So it still would have beaten everything else. But would you want to say, oh, it's a store of value? It's gone from 69,000 to 1,000. But just because it went from a penny to 1,000, you're going to talk about what a great store of value it is? So they're just looking at the fact that it went way up and claiming that represents a store of value. No, it just means that the people who got in early were able to cash out and get a windfall. But it hasn't stored anything. I mean, you can't be a store of value when you don't have any underlying value that you could store. There's no value in Bitcoin. There is a price. There is a market price for Bitcoin, but you can't store a price. Prices are very volatile. They depend on supply and demand. You can have no value and you can have a high price if people are dumb enough to pay it.
Right. All right. So final question to both of you. You both talked about an alternative to the dollar. What exactly is this alternative? Or what should it be? David, I'll start with you.
Well, I think we're going to have to use hard assets to guarantee the dollar. I think that we're in such a difficult bind financially that particularly with foreign investors, and that maybe is a nuance that I've just kind of stumbled on lately, is that we could have a two-tier dollar, kind of like they do in China, where we have a dollar that's used for foreign trade that is backed by real assets, whether it be gold or a basket of real assets. And so U.S. investors really don't get that benefit, because that's the way it was with gold for a long time. We talked about how Nixon took us off the gold standard in 1971. Well, really it was illegal as a U.S. investor at that point to own gold still. It didn't change until Peter would know for sure, I think maybe 1980. But if you were France, you did theoretically have the right to ask for gold. And once they asked for too much gold, that's when Nixon, took us off the gold standard once and for all. So I think we could be going back to a two-tier dollar where we do have at least some of it backed by hard assets, but maybe the situation gets dire enough that we have to have real backing for everything. One of the nice things about the United States versus Germany in the late 20s, they had very little. I believe that the way they collateralized, if you will, the Deutschmark, or I think the Reichsmark is what it was at that point, is with the real estate of the country. Well, we've got an enormous amount of real estate. We've got an enormous amount of other physical assets. We've got the means to do it. Whether we've got the political will to do it is another story. But I think the situation is going to get dire enough where there's no choice at some point.
Peter, what's your alternative?
Well, a lot of people think there's no alternative to the dollar. They say, oh, well, the world is stuck with it because it's the cleanest dirty shirt in a hamper. And I think they're mistaken. First of all, I don't even think we're the cleanest dirty shirt. I think there are other dirty shirts that actually are less dirty. But I would accept the fact that the euro, the yen, the Chinese RMB, these currencies are not suitable to replace the dollar either. I think the alternative to the dollar is gold. I mean, that is the obvious alternative. I mean, prior to the dollar, it was gold. I mean, gold was the international reserve. And even when Bretton Woods and the world went to the US dollar, it was predicated on the dollar being backed by gold. I mean, the dollar was convertible at a fixed exchange rate. At the time, it was $35 got you an ounce of gold. And the whole expression, the dollar is as good as gold, is because it was gold. I mean, legally, the dollar was a weight of gold. And so everybody that owned Federal Reserve notes owned IOUs for dollars, for gold. When Nixon defaulted on that promise and we told the world, you're not going to get real money for your notes, you can't have the gold that we promised to pay. It's like we wrote checks and we told the world, you can't actually cash the checks, but you're free to use the checks and negotiate them among yourselves. You just can't take them to the bank and get what we promised. You could just, circulate these bum checks. But I think the world is going to ultimately reject that dollar. And then what's left? You just go back to gold. And so I think more and more of these central banks are going to be backing their currencies with gold. And I think that's why central banks have been buying gold and why they will continue to buy gold, because they're preparing for the day when they have to back their currencies with real money again. They won't be able to back their currencies with dollars because the dollars won't have much value. And that means the United States, we're going to have to back our currency with something again. We still have a lot of gold, unless we're lying about how much we have, but we still have it. And yes, the U.S. government has a lot of land that it could sell to try to.
Let's do an audit. Let's send Peter Schiff to Fort Knox. We'll make a petition. We'll send do a little tour. Report back to us, Peter. All right. Well, thank you both, gentlemen, for a very thorough discussion. Where can we follow your work, Peter? I'll start with you. Where can we follow you? You've got a very active Twitter account. Where else?
Well, you can follow me on Twitter. I'm getting close to 1 million followers now. I got to get over the top there. But I do my podcast, The Peter Schiff Show. You can listen to that at Schiff Radio. You can also subscribe to my YouTube channel. I've been doing them live recently, so now they have video again on YouTube. Got about, 550,000 YouTube subscribers, so got to get some more of those. And of course, if you want to work with me, through my company, I've got Schiff Gold. People want to buy physical gold and silver. And if you'd like me to actively manage a portfolio for you, you can contact me at my company, Euro Pacific Asset Management. It's europac.com is the website, EUROPAC.com. And if you want to, do it yourself, my mutual funds are available, no load, on all of the major discount brokerage platforms. And you can learn about those funds also on my website at europac.com.
Excellent. And David, when can we see you with these boxing gloves that you got behind you?
Haymaker at Substack. That's where you can get our free newsletter, by the way, which we publish on Mondays and Fridays. And we do have market action related recommendations, as much as the SEC will let me get away with during the Friday newsletter. And then, like Peter, we're also money managers. That's what the Evergreen GovCal is. So you can go to the Evergreen GovCal website. We manage about $4 billion there, separately managed accounts. And so it's pretty easy to find me.
Thank you both, Peter and David. Look forward to speaking with you again next time. Take care.
All right. Take care, everybody.
All right. Bye. Take care. Bye-bye. Thanks for watching.